Suppose you're holding a stock portfolio that tracks the S&P 500 index in some way. However, research shows that the stock market might come down due to some noise in the energy markets, for example. So what can you do? Well, you can sell some of your stocks and buy them back later when prices drop as expected. But that will incur trading costs and other expenses, and if the drop was not significant, well, the cost might outweigh the benefits. Or number two, you can do nothing and let the value drop, at least saving on transaction costs. Or you can hedge using the futures contract. Hedge? What is hedging? Well, it can mean reducing exposure to price fluctuations, volatility, or adverse market movements, to ensure a particular outcome happening. The most basic hedge, of course, is fixing the price in the future via derivatives such as forwards or futures, as we've discussed before. But that's not the only way to do it. Listen up and see how you can hedge your market positions with futures contracts using the hedge ratio. Going back to the problem, if your stock portfolio is expected to drop and it matters what the S&P 500 might do, then what you can do is short the S&P futures so that any gains in the futures market will offset the drop in the spot market. Long the spot, short the futures. Remember our previous videos that a short is akin to selling? So instead of selling portions of your stock position in the spot market, you sell or short the futures instead. Well, if you didn't quite understand that, no worries. That's what we're here for. We'll discuss that in detail below. Note that here we are using another meaning of the word hedge. Yes, you're hedging by fixing the price to buy or sell in the future, but you're also hedging by offsetting expected losses in the spot with gains in the futures. So here to hedge means to offset expected losses from a position by taking a counterbalancing or opposite position in a corresponding instrument, thereby ensuring that your portfolio value is more or less fixed as an investment outcome. So if the market drops 1%, for example, and the futures mirror the spot and drops 1% as well, your short position offsets the long position, which is your current stock portfolio that you own. It is hoped that you will offset each other. Now let's explain that with some examples below. As in previous videos, we'll work with mock data to make the examples plainer to see, and just talk about a stock portfolio, a market index, and the market index futures. Let's use this hypothetical data, which is also uploaded to our data archive. See the video description below for the link. Now let's visualize our data and see what's going on using a two vertical axis or combo chart in Excel, given that the levels are different for the portfolio, which is running in the millions, and for the market index and futures, which are running in the thousands. Clearly, they are all moving in a related manner, and therefore we can try to take advantage of the relationships between and among the three data sets. Now, people might be tempted to do regressions and statistical analysis on these levels, as some of my former students were wont to do. But stop. Don't do that. What matters is not the levels, but the movement across time. So I just included these charts here just to clear up the matter. These charts are useful to visualize relationships, but don't do your statistics based on these levels. Instead, we are more interested in movement in time. So we can go for, let's say, delta prices, price now minus price previous, or delta prices divided by previous price, which is nothing more but the returns, meaning price now over price previous minus 1. Now, using this form, all the data are directly comparable already, and clearly they're all moving together, and this seems quite useful. Okay, now what? Well, the best thing to do next is to regress the returns of the stock portfolio, not with the market index, but with the futures index, since we're attempting to use the futures market to hedge our stock portfolio. So we now track the returns of the portfolio with the futures. A cursory look at the scatter plot between the two shows the following, showing a high R-squared between the two sets. Now I'm going to show two charts, one with the index futures on the x-axis and one with the stock market on the x-axis. So here they are. Note that while the R-square is the same whichever way, The linear regression results are different. Now, the more interesting question here is which one should we choose? Okay, here is the key point. Because we want to use the futures to hedge our stock portfolio, we are really asking ourselves how much of the futures should we get so that it tracks the stock portfolio. If the correlation was exactly equal to 1, and it doesn't matter how we present the data, there'll always be a one-to-one correspondence. But in this case, it's clearly not. So what do we use? In general, so that it's easier to analyze this moving forward, I recommend that you use the hedging instrument, in this case the futures, on the x-axis and the stock portfolio being hedged on the y-axis. This is so that you are basically always orienting yourselves relative to the hedging instrument, asking yourself, per 1 unit of the hedge instrument, what is the impact of the stock portfolio? This gives you the information about how much of the x-axis you need to impact the y-axis. That is, how much of the futures you need to have an effect on the stock portfolio. Now, let's run our regression using the futures return on the x-axis and check the results as follows. It turns out that the alpha of 0.00095 has a p-value of 0.39. So we accept the null hypothesis that it's no different from 0 given an alpha of 5%. The beta of 0.7105, however, is significantly different from 0 given the p-value and an alpha of 5%. So essentially, the relationship between the future and the stock portfolio is that for every 1 unit of change in the futures return, it produces a 0.7106 change in the stock returns, like so. Now, let's talk about the hedge ratio. It turns out that the beta of the regression with the futures on the x-axis is exactly called the hedge ratio and tells us how much of the futures we need to contract. And here beta is 0.7106. Remember how to also compute for beta? It should be useful for academic exams, or say if you're taking professional certification exams such as the CFA exams. So these are the formula. Beta is equal to covariance of xy all over variance of x, or alternatively beta is equal to the correlation coefficient rho times sigma y over sigma x. From there, the question now is how many futures contracts do we need to short? Here's what we need to know. The number of contracts would be H, or the beta, times the portfolio value over the futures contract value. And the futures contract value here in this case will be the multiplier times the futures price. So in our case, if we take a look at the portfolio value as of last date, it's 1,020,838. And then the multiplier is 50. And the futures price last time, which we're presuming that's the price we got into the contract, will be 7,164. So the number of units per contract is 50 that we're using here, such as for the E-mini S&P futures. But in practice, for actual multipliers, please consult the futures contract you are exploring. So again, going back to our problem, at the price of 7,164, one contract is currently priced at 50 times 7,164. And that gives us roughly 2 contracts that we need to short. Note that the beta and the correlation is positive. So you need to short 2 contracts so that the movements are expected to offset each other because they're positively correlated. If you had long the futures, you're doubling down on the movement since both will be moving in the same direction on average. While what we want is that the movements cancel each other. However, if the correlation were negative, then now's the time you long the futures since they are moving against each other already quite naturally on average. Now let's take a look at 2 possible scenarios going back to the original problem. Prices going up or prices going down. Here the futures position is marked as negative because it is a short position as opposed to the positive sign of the portfolio to indicate that it is long. The long position gains money because prices went up, so the stock portfolio should gain value. However, since the futures contract is a short position, the upward movement in price produces a loss. Now, it might take time to grasp the signs, but trust me, you'll get used to this eventually. Now, what happens if prices come down? This time, since prices went down, the stock portfolio value went down, but the futures value went up because of the short position. The key point here is that the P&L should offset each other, which is the point of the hedging exercise. In a perfect world, if the futures went down by 1%, then the stock portfolio should drop by 0.71% as expected via the regression. Now, what would have been the gains and losses in this case? So it turns out over here, we have this number quite close to zero, but not quite zero. So they nearly offset each other. And in fact, if we had fractional futures contracts, the offset would have been more or less total, as shown here in scenario 4. Now, this points out the idea that the multiplier for the particular futures contract is important to accommodate more precision in the number of contracts. For the S&P 500 futures, that would be depicted here in this table. Now, the full-size S&P is rarely traded nowadays due to high margins, while E-minis dominate for hedging portfolios and micros scale it down further for precision. As can be seen, there's a different complication if the spot market does not drop at all, with both the spot market and the futures going up instead. So while the future value of your stock portfolio is going up, your short position in the futures market will produce a loss, dragging down your return versus if you had not hedged at all. In this case, you might be blamed for hedging your position in the first place. They're going to say, oh, why did you invest in futures? You produce a loss. And this is a clear misunderstanding of what hedging is. And this is why the definition of hedging has to be made clear to the decision makers who will approve the hedge. The hedge is put in place to obtain a desired outcome, to ensure that the portfolio does not lose value given price volatility. The long spot short futures in a perfect world and a perfect hedge would ensure that the value of the portfolio remains fixed despite price volatility. That's the whole point. If that were not the desired outcome, then perhaps it's not a hedge that is desired, but more like insurance against directional outcomes. In this case, insurance against dips in prices only without losing the upside potentials. In this case, what would be needed are options. This is an upcoming topic in our future derivatives videos. Okay, that's all that we have for now. Please like and subscribe to help support the channel, and see you next time.